Good morning, and welcome to the Energy Perspectives Group webinar hosted by Arrow Copper. This event will be recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speakers.
Hi, everybody. Welcome. I'm very excited about the company that we have presenting today. But before I introduce today's speakers, I want to tell you why I am personally very bullish on copper and other strategic metals that will be high in demand as humans transition to using more electricity in their daily lives. The increasing number of electric vehicles is just part of the expanding market for copper around the world, providing reliable electricity to the populations in the developing nations will drive higher demand for copper. It's already started. In May of 2021, copper futures traded at an all-time high of $4.90 a pound. That's up from $3 a pound at the beginning of the year. The price chart for copper looks very much like the price chart for oil. Thanks to the fear of COVID Delta variant, the price of copper pulled back to $4 a pound on August the 19th, but it's since rebounded and is all the way back to $4.27 as of yesterday's close. I believe that copper prices will move quickly over $5 a pound in the post-pandemic world. This compares to Arrow Copper's cash cost to produce a pound of copper is less than 70 cents a pound. So it's got a tremendous profit margin, cash profit margin. Arrow Copper was incorporated on May 16th, 2016. It trades on the New York Stock Exchange with a market cap of 1.7 billion US. Arrow has a strong balance sheet, and the company reported net income of 136.3 million and operating cash flow of 147.2 million for the 6 months ending June 30th. If I double that 6 months, the stock is trading at a PE ratio of under 10. Most of the company's revenues come from the sale of copper, but it also has a profitable gold mining operation. So we have two speakers today, David Strang and Mako DeFilippo. I'm sorry if I butcher that. David is the co-founder of Arrow Copper and now the CEO and director. He previously held senior executive roles with all of the aluminum group companies, including as director, CEO, and president of Lumina Copper, Aluminum Royalty, Global Copper, and Lumina Resources. Lumina Copper was sold to First Quantum Minerals Limited in August of 2014. David has approximately 20 years of corporate finance experience, particularly in the areas of corporate and asset valuation, and has approximately 9 years of experience as an officer and director. He holds a Bachelor of Science degree in Applied Earth Sciences from Stanford University. Mako was appointed president in January 2021. He was previously the vice president of corporate development. He was previously director of corporate finance with the FTI Consulting Global Mining Advisory Practice. He has a background in diversified mining finance and strategic planning. He holds a Master's of Science degree in metallurgical engineering from the Colorado School of Mines and a Bachelor of Science degree in geological engineering from the University of Arizona. So now I will turn it over to David for the presentation.
Dan, thank you very much for that very, very kind introduction. I think Mako and I are very much obviously supportive of your views with regards to the copper price and the copper market and where we see that market going in the future. I think we are at the precipice of a very significant change in how the world uses power, particularly energy, whether it be people driving their cars to work every day or how they go about working within their own homesteads. And so copper is, as we like to say, the vein infrastructure of the global economy as it goes forward in terms of its greening. And so we feel we're very, very well placed in terms of taking advantage of that going forward with the continued growth of Arrow. And that's what we'd like to be able to share with all of our the participants here today. So thank you very much for that intro. Let me just jump into the presentation. As usual, there are a number of cautionary statements that need to be taken into consideration. Obviously, we will not go through these in any great detail right now, else that would take up the full hour. But please, if you need to be looking at these, please go to our website and refer them there. So let's jump into Ero Copper and our business strategy. Our company is defined by 5 core principles that we operate by. We are a very return on invested capital focused management team. Everything that we do is focused towards generating the highest returns on invested capital. Now, everybody may talk about that, but as we'll show in this presentation, I think we've got a track record to support that in terms of that being a core principle of our company. How we go about doing that is through maintaining operating costs within the lowest quartile of the cost curve. And we continue to do that. As Dan mentioned, we have operating costs currently at 70 cents a pound. We have a long-term forecast and strategy and discipline of maintaining our operating costs below $1 a pound of copper produced. As we'll discuss in the presentation, we have a very significant organic growth potential and growth profile for the company. Again, if you're able to grow your assets, grow your production from assets that you already own, your return on invested capital is going to be significantly high. And again, we have industry-leading low capital intensity in our ability to do that. And that's due to the fact, in terms of our acquisition of the company back 5 years ago, it had underutilized mill capacity, both within the MCSA mining complex, along with our NX Gold gold mine. And this is all encapsulated around a strong ESG culture and performance. Safety is a paramount of importance to us as a company. We believe employees should have the right to be able to go home every day and be with their families post-work. And so we're very, very proud of our safety record as a company in terms of our employees and looking after them. On the right-hand side, to give you a bit of focus, as Dan mentioned, we are operating in Brazil. My background, I have operated the majority of my career in South America, so I have a significant amount of experience working in South America, whether it be Argentina, Chile, Peru, Colombia, and now Brazil. Our core assets, single largest assets, MCSA mining complex, which is located in Bahia state in northeastern Brazil. This is where we produce the majority of our copper. We have the NX gold mine, which is located in the Mato Grosso state. And then, as we'll be talking about during the presentation, and one of the outlooks to look for over the next month or so is our updated feasibility study of the Boa Esperança development project, which we hope to be able to announce construction or beginning of construction sometime next year. When you look at our portfolio overview, as I said, on the left-hand side, the MCSA mining complex, it is our flagship high-grade, low-cost operation. We continue to have about 1.3 million tons of excess mill capacity there, about 25% increased production potential. And so currently in our latest, what we call the technical report of 43-101 report, we have a forecast life of mine plan in which we'll produce between 42 and 50,000 tons of copper per year at just under $1 a pound cash costs. On the next slide, we have the Boa Esperança project. I've put this in a little box in terms of its current production and forecast metal prices. We are in the process of optimizing the feasibility study, and this is a significant growth opportunity for us. We certainly believe that we will see increased copper production at similar operating costs when we start looking to release the updated feasibility study in September. While we're optimizing that study, this existing study is already a fantastic project. You know, with an internal rate of return of over 32% at $3 copper, you can start to work your way forward to suggest what is that internal rate of return is going to be when we look at metal prices in excess of $4, of which they are today. And then on the far right, our NX Gold mine, Not the biggest gold mine in the world, but certainly one of the more profitable ones. Operating costs right around $500 an ounce. If you look at gold today, we're trading just over $1,750 an ounce. And so very much, I like to call NX Gold Mine almost the mini-me of MCSA mining complex. It has a lot of the same attributes, just smaller than MCSA. So we have excess mill capacity here as well. We have in both operations, very large land package in which to continue to develop new deposits. And we have one of the largest drill programs ongoing in the world today. At the MCSA mining complex, we have over 24 drill rigs currently operating. As you can see at NX Gold, over 9. And we haven't listed it here at BOA, but we'll have over 5 to 6 drill rigs there over the course of the next 3 to 4 weeks. We currently have 3 there right now. So in aggregate, over 35 drill rigs drilling on our properties, developing new sources of copper and gold for our future growth. And I've been on record as saying, if you're looking at us as for the first time today, we are going to be, and we'd like to be in a position by the end of this year to be able to show the marketplace a doubling of our production over the course of the next 2 to 4 years at industry-leading operating costs at below $1 a pound. And that for you, if you have to take anything away today, should be the core outlook in terms of why Ero should be part of your portfolio, is that opportunity in terms of significant growth that we have internally growing from our own assets. Just coming back, and we'll talk about ROIC. Again, it's incredibly important to us that everything that we do in our business is focused on this. Since we went public in the third quarter since we went public in 2018, and we were able to start using the Bloomberg data, as you can see, our return on invested capital over that time period has been in excess of 30% per year. We're currently significantly higher than that. Why is that important to us? That's important to us from the standpoint of management are fully aligned with our shareholders. I'm fortunate to be the third largest shareholder of the company. And so for me, and for my business partner, Noel Dunn, who's the 5th largest shareholder of the company, it is important for us that we are aligned with our shareholders in terms of not only our own portfolios, looking to generate the highest return we can on the asset base that we have invested in. And we are very, very proud to be able to show this graph in terms of our abilities and what we've done to date and what we intend to do as we go forward. As we spoke about operating costs, when we acquired the company, it was operating around about mid-market in terms of its cost profile, $1.45 a pound in 2017. As Dan mentioned, we're currently operating around about 70 cents a pound, and we're forecasting for the year between 75 and 85 cents a pound total operating costs. That puts us firmly in the bottom 3rd quartile of the cost curve in our industry, and that's allowing us to continue to increase year on year our profitability, if you're looking at our EBITDA and what consensus is for this year. And at the same time, if you look at how management of our debt, very, very manageable debt levels down at 0.5 in terms of debt to adjusted EBITDA ratio. As I said at the beginning and what I've talked about, we have significant organic growth opportunities within our portfolio. And so as we kind of highlight here, what is the potential? As we mentioned, the MCSA mining complex on the left-hand side here, current life of mine plan between 42 and 50,000 tons a year of copper production. We kind of give a bit of an estimate of what the additional capacity in the plant is. And we're given that guidance right now around 14 to another 20,000 tons of production. And as I mentioned earlier, with the BOA Esperança project, our current 43-101 plan has about 20,000 tons of production. We certainly feel we can make improvements upon that. And hence the reason I'm fairly bullish in being able to talk about over the course of the next 2 to 4 years, our ability to take up current production from where we are this year, around about 44,000 tons of copper production and doubling that over the next 2 to 4 years. When we acquired the company, our first year of production was 22,000 tons of production. Over that next 4 years, we had doubled it to 44. And as I said, over the next two to 4 years, we believe we can double it again, putting us at a very, very high profitability business. And likewise with our gold business, we see great opportunities there as well in terms of taking advantage of the excess capacity of the mill and our exploration expertise that we have in-house in both operations and being able to look to continue to double production. For instance, when we acquired the gold business, it had an 18-month life, remaining life in the mine. It actually didn't have any reserves. We've subsequently increased that now to a 9-year mine life. And we certainly believe that we not only will continue to lengthen the mine life of our gold operation, but also looking to significantly increase production there as well. Talking about Boa again, as I said, it is front and center for us right now. We will be coming out with the optimized feasibility study in September this year. Probably look for that somewhere around about mid-month is our hope to be able to do that. As I said previously, it's a great project. We inherited this when we acquired the company in 2016. Mako and the rest of the team had an opportunity last year to start re-looking at that study. As you can well imagine, when we acquired the company, we had a lot of work to do with our existing operations, MCSA mining complex, NX Gold, that we just didn't have the resources and time earlier to be able to look at this project. Lo and behold, like the opportunity set that we saw MCSA, like the opportunity set we saw NX Gold, Mako and the team found significant opportunities here to improve and increase the opportunity with regards to the Boa. And so we're working towards that in the optimized study, and we'll be, as I said, releasing that in September. What we can say is if you look at other development projects around the world in terms of the copper business, and you look at it on the basis of capital required in terms of return, etc., and what we're trying to show in this graph here, what that shows is our capital intensity. Again, that word, how much capital do I have to put in order to produce a ton of copper, is one of the lowest in the world. Our return on that capital is one of the highest, and we're very, very excited about Boa and the prospects for it coming into our portfolio in terms of production over the course of the next 2 to 4 years. So let's take a step back and look at the other aspect of our business I think is important. So we've kind of painted a little bit of a picture here for you all with regards to where we see near-term growth. But as Dan mentioned, a lot of you are interested in investing in the oil and gas space. And so I want to try and bring the other sort of leg of the value chain that we have to provide to the marketplace is in our exploration program. We control one of the largest exploration districts in the world for one of the most valuable deposit types in the world. So what does that mean? We produce copper from a type of mineral deposit called magmatic sulfides. Magmatic sulfides in general per ton of rock mined are the highest value in the world. If you follow the mining industry in any detail, you will have heard of mines like Norilsk in Russia, which is the most profitable mine in the world. You may have heard of the Sudbury Basin in Canada that has been mined for over 120 years. More recently, and one of the big stories was Robert Friedland's discovery of Voisey's Bay in the 1990s. We have the exact same mineral types as that. The difference being is we have a mineral district that was underexplored. And the reason why it was underexplored is this was held by private individuals for 25 years when the Brazilian government privatized this asset in 1994. It was acquired by people who had no knowledge of the mining industry. They used this as their personal piggy bank, and so didn't spend any time exploring the property. We're the first company to bring in significant exploration resources. As I mentioned, one of the largest exploration programs in the world today, along with intellectual capital that we have in terms of our geological team to look to understand the value equations available in the Curaçao Valley, what we show here. What we have on the bottom is highlighting drill holes, drill results that have been drilled by mining companies over the last 3 years. And these will show you that we have 30% of the highest grade, and we measure this by grade by meter basis, that have been drilled in the world over the last 3 years. That's quite an accomplishment and really stands towards how interesting, how potentially profitable the Curaçao value is. Our biggest enemy is time. Hence the reason we're trying to use one of the largest drill programs to try and understand the district as quickly as possible. Because every time we are drilling, as you can see in the graph below, we are finding some of the highest grade opportunities in the business. And so we're super excited about the exploration that we're doing here. And this is something that you will continue to see us focus on as we go forward. We put out an exploration update every quarter, about 6 to 8 weeks behind our financials. And so be on the lookout for the next exploration update on the Valley towards the end of September, beginning of October. Likewise, albeit on a smaller scale, again, using the mini-me analogy from Austin Powers movies, we have NX Gold, we have this similar type opportunity set. Not as big a area, dare I say, but certainly an extremely interesting one. We are the first company to drill this district. The previous owners never drilled since from the time they built the NX gold mine, and we have now systematically started to do regional exploration. In our last exploration update, we announced the discovery of the Mata Verde system. That's around about, I've got to convert it into miles for you guys, but that's around about 15 to 20 miles away from the mine site. Brand new ore-bearing high-grade gold discovery. We've made a new discovery about a mile north of the existing mining operations, and we continue to make discovery within the mining operations in terms of extending and delineating the opportunities there. And so our gold opportunity, while on a smaller scale, is just as bright as what we have within the MCSA mining complex. Just want to talk about, we announced a month ago a streaming transaction in terms of putting additional capital into the company, and really speaks to our focus on return on invested capital. And as we continue to look forward and financing the growth opportunities in the company. We announced that we had done a deal with Denver-based Royal Gold, in which we essentially sold forward 25% of our gold production until we produced 93,000 or delivered 93,000 ounces to them for the sum total of $110 million. When you equate this transaction and look at it from the standpoint of financing, this was a negative cost of capital to us in order to do this transaction with them. And so we just looked at this as very good financing engineering, good financial engineering in terms of looking at our company in terms of continuing to grow it. We will obviously require capital to build Boa. We are putting in a new shaft at the Pilar mine in the MCSA mining complex in order to unlock additional value. And so just an example of a recent transaction that we've done, which we feel continues to support our focus on return on capital for our shareholders in terms of just doing some smart financial engineering. Happy to talk about this in more detail in the question and answer period, if you so wish. And then coming to, certainly it is not lost, it forms very much the front focus for us as a company in terms of our performance. We're happy to say over the last year, we have not had a lost time incident or accident at our MCSA mining complex. From an environmental perspective, we process and reprocess 87% of the water that we use is recycled. We continue to focus, and we should be focusing on climate change and working of how we can continue to improve our operations in terms of climate. And then, of course, with us being in Brazil, very topical in the news with regards to COVID. Very, very proud of the team that we have in Brazil with regards to what we've done with our local communities, and particularly everything in Northern Bahia, where we are essentially the economic engine of Northern Bahia in terms of what we've done there with respect to COVID. Very, very proud to say that the team did not have one lost day in terms of production, in terms of the work that we did, in terms of working with the community, local government, in terms of our production. And so something we continue to focus on. Happy to say, and it's quite remarkable, with respect to our gold mine, we have 95% of all of our employees are vaccinated, at least having one vaccine, and MCSA mining complex, I believe we're now up to 30 to 35% and continuing to move forward with regards to vaccination levels there as well. Talking about corporate and capital structure, very proud with respect again that we have a very strong core shareholder base. T. Rowe Price is our largest shareholder, just over 15% of the company. Fidelity close behind at just over 12%, and BlackRock being our third largest institution within owning the company. As we have said, well aligned, myself, Noel Dunn, Mike Richard, who's our chief geologist, are some of the largest shareholders. So we are with you in terms of the journey that we have undertaken. Our balance sheet remains strong and growing. $238 million of cash and cash equivalents, including the transaction from Royal Gold, just under $160 million of debt, and then basic and outstanding share structure on the right-hand side. Just briefly on guidance, and talking about guidance, some of you wish to know that. We reiterated guidance during the second quarter, after our second quarter, albeit that we are skewing things towards the higher end of our guidance in terms of production. On operating costs, we are seeing guidance being closer to the lower end of our guidance for the year. Our capital expenditure forecast and exploration forecast remain largely unchanged for the year. And then I'm just going to leave you with our 5 core principles again. Hopefully, as we've walked through this presentation, you, albeit briefly, have got to know how focused we are with regards to return on invested capital. I'm not sure that's said enough within the mining industry in terms of that focus. We are a first quartile operating cost. So as Dan mentioned, as we move forward here with metal prices, our ability to see significantly higher margins by controlling our costs are there, and we're going to benefit enormously from this copper revolution and the greening revolution. We've got significant organic growth, an exploration portfolio second to none in our industry in terms of opportunity. And as we've shown, we're industry leaders in terms of our ability to convert discovery into production with regards to capital requirements. So Dan, I am going to leave it there, hand it back to you, and certainly we're open to questions from everybody, and I hope everybody enjoyed the introduction to Ero Copper.
Yeah, great presentation. And I want to tell everybody before I forget that there's a lot more detail in the presentation that's on the company's website, including some 3D maps of the copper and gold mine. They're very interesting, and it shows how much exploration upside they have. Okay, I received 7 questions via email, so I will go through those first. I think you really addressed most of these, and then we'll get to the chat box, which I see they've got about 3 or 4 questions there. Remind everybody, if you're on the live webinar, you can just go to the bottom of your screen, click on the chat box, and type in a question there, and we'll get to it eventually. Okay. Based on some of the feedback that I got from EPG members that attended your recent luncheon in Houston, what are your thoughts on dividends for this company based on the extensive free funds flow potential, and then the recent royalty deal that pushed a lot of cash into the company?
It's a great question, and I ask management every day as well as a large shareholder. um, Look, I think it's important, and all jokes aside, to really focus with regards to my background, coming from a mineral economics background, a valuation background, is very much focused on how do we make, and again, it comes back to the very first line we have here in you can see in the investment summary. Dividends are a product of return.
Right.
If we are able to continue to maintain a high rate of return on invested capital, ultimately dividends will flow from that. At the moment, when we look at our portfolio and we look at our available free cash and the opportunity set, we see opportunity with regards to the Boa project. We see opportunity with regards to putting in the shaft at the Pilar mine as generating a higher rate of return and continue to, in the longer term for our shareholders, that we could improve dividends down the road. And so very much right now, I would consider us still very much in the growth phase. With projects in your portfolio that are generating returns in excess of 30%, I think investors and our shareholders are very focused towards us reinvesting that capital in order that they can benefit from those returns down the road. But there's no doubt, if we continue to maintain these high levels of return on invested capital, at some point dividends will come from that. And so I think that's the best way that we can answer that right now.
Yeah, I looked at your financials for the first 6 months of this year, and it looks like you've got had quite a bit of free cash flow for the first 2 quarters, and then also you added that slug of cash that came in on the gold royalty deal. So right now you've got enough cash flow from operations and cash on the balance sheet to fund this year's exploration program, don't you?
Oh, absolutely. Oh, absolutely. Okay. No, I mean, the intent that we want to be able to do, obviously longer term, is finance everything from internal cash, right?
Right.
When we look at things like building Boa or putting in the deepening, the shaft into the deepening project, certainly the shaft and the deepening project look very comfortable in terms of self-funding with regards to free cash flow. When we look at the Boa project, part of the reason we did the stream is in terms of looking at Boa and coming towards helping with that construction of that project. I think as we go forward, there will be a little bit more debt that will be put on our balance sheet as we look to build Boa. We're still working through all the financing structures with regards to that. But as I said, for us, it's almost like a working capital issue in terms of our cash flows. Mm-hmm. Funding great projects like that sometimes does require you to seek some funding in different avenues than just using free cash flow. But certainly it is our wish that everything that we fund is from free cash flow. Things like exploration would never be funded from external sources. That has to be funded from internal free cash flow. That's just intuitive sense to me.
Yeah, it's just like an oil gas business, going out and doing a high risk drilling program and funding dry hole exploration wells with debt is not a good idea.
Hell no.
Hell no. That's what gets you in trouble, man. Yeah. To focus on MCSA. Now, MCSA is the existing copper mine, and you own like 99% plus. Why don't you own 100%? That is just a question for me.
That's a great question. When we first acquired the company in 2016, there were some minority shareholders outside of the core 3 large shareholders who held shares. Through a combination of reinvestment or investing new capital into the company like we did, it didn't take us up to the 400%. We own 99.7% of the MCSA mining complex.
Oh, okay.
It's a very, very low amount.
Okay. Just focusing on that mine, how much CapEx do you have to expand to get that up to, like 80,000 tons a year?
So that's a good question. So if we look at our existing mining complex there, the mill structure there, depending on grade, and the mill infrastructure can produce between, if we go back to the original capacity of that mill, we can produce anywhere from probably 60 to 80,000 tons of copper per year there. With regards to us going back, it's actually quite small capital. We're looking in the order of maybe $30 to $40 million to some refurbishment in the mill over the next few years. But certainly, as you can see, what we've been able to do so far, you know, when we took over the company initially, we were running about 1.8 million tons through the mill. This year, we're probably close to 2.8 million tons. We'll be at about 4.2 million tons through that mill in a couple of years, Mako, 2 to 3 years from now. And so as we go forward, what is great about the Curaçao Valley, and so to give you, when we talk about a mine or the complex, the reason we're doing that is we have imagine this as an offshore oil platform. We have a central floating platform that you're processing your oil and gas from your various wells. We're very much similar hub and spoke. We have a central processing plant, and over this course of the Curaçao Valley district, we are currently mining from 3 different mines. We have the core mine called Pilar, we have the extremely high-grade mine called Vermelhos, and we're mining from another area called Surubim. So we're very much a hub and spoke complex in terms of what we do. So our ability to bring a new mine into production is not like what you see around the world with some of these mega projects where you're looking at billions and billions of dollars. For us, we were able to start producing over 20,000 tons a year from the from the Vermelhos mine, which we started from scratch at a cost of about $56 million. So when we talk about capital intensity, that's really the function here. As opposed to the industry average grade of copper that is mined per year around the world today is around about 0.6% copper, i.e. it's about 22 pounds, no, sorry, there's about 18 pounds of copper per ton of rock. We mine currently at 2%. So we are triple the average grade mined in the world. So by default, our profitability is significantly higher, but also the cost for us to build each of our mines is very much lower than the rest of the industry.
Yeah, it's outstanding. I'd say we've looked at several mining companies, probably a dozen of them, and they're these early stage mining companies. And, you know, I can definitely see their potential, but the problem I have is I can't quite grasp how they get cash flow positive. You know, it's like how much money you got to spend before you start generating, you know, positive cash flow. And that's hard for me to judge. And I'm just, you know, I'm not from the mining industry. So that's what I love about your company. I mean, you're already there, and it's really easy to see that you've got some low capital intensive projects that can bring on a lot more cash flow. So
well, yeah, if you think about it, if you I'm trying to think, I mean, apologies, I'm not as well versed in the oil and gas business. But if I cast my mind back to some of the companies I remember, we're unlike the Exxons or the Shells of the world, et cetera, who really have to find growth through acquisition, which the majority of the copper mining companies in the world today have. We're, I think, are more like, and if I remember, Anadarko. Anadarko with a great exploration portfolio was producing, and I may be wrong, but I thought Anadarko was more like that. And then ultimately, you know, I had a great exploration profile and had the portfolio to be able to grow its portfolio organically. We're one of those kind of companies in the oil and gas sector. We have a portfolio of growth. It's not a case for us whether we are finding copper or not. It's that we're feeding from a fire hose with regards to our exploration program to try and get the highest quality the quickest. We don't want to go necessarily right now. For instance, we could fill the mill tomorrow with low grade increase our cost profile of the business and just pump out inferior oil or inferior product. But we have chosen to maintain high returns on invested capital by going after quality production as opposed to quantity production, because we ultimately feel that capital in our business is a long-term operating cost, and it's not quantified correctly in terms of just looking at mining low-grade material versus high-grade. So that's what we're very focused on. We're focused on quality production.
You know, what I've seen on the oil and gas side is, you know, these shale companies, and you've heard, you know, all these analysts saying that you can't make money in the shale. I think the one good thing from the pullback in the oil price was it forced the companies to really high grade their drilling programs. You know, not just go out trying to hold acreage, but to focus on the well sites that had the best rate of return. And as a result, and now with, you know, the same thing you're seeing with the copper price soaring, with the oil price doubling since the first of the year, now these companies look incredibly profitable, just like yours. Okay, here's a question. You recently uplisted or dual listed on the New York Stock Exchange. Can you say, why did you do that? Are you thinking about raising more equity capital? Is that out there possibility or what?
Well, equity capital for us is just, if we were to look at equity capital, it'd have to be looked in the context of requirements for the company. And I know that's a bit of a talk around question. We can never say never to with regards to equity. Certainly, where we look at equity versus our balance sheet and what is required today and other sources of capital, it appears to be expensive. So, you know, you can never say that with regards to raising equity, whether you would or wouldn't. I think it's naive to say you would never raise equity, because shareholders, if the project gives a return that is in excess and that equity, some shareholders would like to participate in that in an efficient manner. However, we did not list on the New York Stock Exchange in order to do that. Okay, we listed on the New York Stock Exchange because we felt that the opportunity set for investors in the United States with regards to access to quality copper investment opportunities was lacking. If a generalist looks for copper in the United States, they really only have two investment sources, and that would be Freeport, based out of Arizona, and then the Southern Copper Mines, which is listed, which is primarily controlled by a group out of Mexico. So you have very, very large producer that is essentially optimized. Yep, you're going to trade on alpha with regards to Freeport. With regards to Southern Copper, fantastic assets, but 75% of the company is controlled by one company. So when we looked at it, there was a lack of growth opportunities in the copper space for US investors to invest in efficiently. And so we looked at listing on New York as providing that opportunity set there in the context of a growing awareness of the opportunities with copper, as you said, the constant return with regards to the electrification of the world, and copper being the basis of that. We felt it was optimum for us to provide an investment opportunity for US investors in a growth company like ourselves.
Yeah, I think when any of these funds that are looking to go green, you know, to be able to tell their fund holders that they're investing in green, I think when they find ERO, they're going to jump all over it.
Exactly.
I mean, you're the most profitable one of these things that I've looked at. And this is a concern that we have in the oil and gas industry all the time is, you know, for companies doing businesses in countries outside of the US, what is your royalty burden in Brazil? And do you see any political risk change in the royalty amount or nationalization of properties? Is that a risk?
Great question. And certainly, you know, as I touched on previously, all I can talk to is my experiences having worked in South America for now going on nearly 17 years. I am pleasantly surprised with our experiences in Brazil. I have found Brazil, and this is surprising to some people who probably on the call, I have found Brazil to be a better operating environment than I ever experienced in any of the other countries I operate in South America, including Chile. While Brazil is bureaucratic, if you are planning appropriately, I have found the Brazilian government, both locally and federally, to be very helpful with regards to the development of resources and our opportunity set in the country. So on a macro scale, we see Brazil very much open for business, particularly on the mining side of things. Now, of course, we probably benefit a little bit more than most of our peers in operating there, because we acquired a company that had been operating for nearly 40 years already. So in Brazil, we are a Brazilian mining company. You do not see a Canadian flag flying anywhere in any of our operations in Brazil. It is Brazilian management, and it has been a phenomenal experience with our team in Brazil. Now let's talk about more granularity. You can never turn down nationalism anywhere in the third world. But where we see Brazil, particularly under the current leadership, and even with the previous, when we acquired the company, when it was run, the country was left-leaning with the Workers' Party, there was never and has not been any hints with regards to nationalization. It's not in the Brazilian vocabulary right now. And within the power structure of Brazil, it would be very, very difficult to do that. And let me tell you why. Unlike the United States, where you have two political parties that are represented in the Senate and the Congress, in Brazil, you have 40. That's 40. There is never any absolute consensus with regards to anything that operates down there. So things change very slowly. With regards to royalty rates, in 2018, the country changed the royalty rate across the board for the mining industry. That was the first time in 50 years that the royalty rate had changed, and that royalty rate was primarily directed towards the iron ore industry. We actually saw very minimal change with regards to the copper business. As you go forward, and there is always noise, within the Senate, there are parties that always are trying to change royalty rates. And to be honest with you, when I first heard about it in 2019, somebody was talking about a massive change in royalty rates. I called our team down in Brazil. I said, what the hell's going on? Is this going to happen? And they all laughed at me and said, that particular senator does it every year and tries to push something through, and it never gains any traction. So you will hear from time to time noise. Currently, there is a bill that is trying to push through Congress, in which they are looking at raising royalty rates. The royalty rate is, and the interesting thing about this is what they're looking to do is increase royalty rates and offset that by lower corporate tax rates. So it's a net zero.
What's the royalty rate right now?
The royalty rate for us is 1.5%.
Oh, wow. Wow.
Yeah. We're talking about de minimis amounts of money here.
Yeah, okay.
If you looked at it, our royalty rate in terms of what we paid the first 6 months of this year was 20 million reais, about $5 million.
Okay. And what's the corporate tax rate?
Corporate tax rate is 15%.
Oh, and it's only 15. Okay.
Yeah.
Well, we're used to much higher.
Yeah.
And probably going a lot higher. Right?
Yeah.
Anyway, the dirty old oil and gas business, we have to keep punishing them. Anyway.
Yeah, unfortunately right now.
Yeah. One thing we talked about before we got on the call here, how much copper reserves are controlled by China, and how much control does China have on demand for copper?
Great question. China actually has very, very little domestic production of copper. If you look at all the things they do have for a country of its size, it's really interesting that it only has, I believe, 4 or 5 copper mines in the country that produce a very, very small amount. So copper, China is an acquirer of copper for obvious reasons. They are trying at the moment. So there's a lot of noise out. As you talked about, we saw very, very strong movement in copper price earlier this year. So it was mitigated somewhat with respect to COVID. But another aspect was the Chinese government trying to talk the market down, not only for copper, but iron ore and many of the other core ingredients it needs for its economy. it's clear to us as people on the inside of knowledge about this, that China is very limited in what it can do longer term in terms of affecting the copper price. And so when we look at China, China does have a say in the short-term volatility of copper, but if you're looking at the long-term pressures in terms of where copper is going, we just do not have enough new supply coming into production to keep up with demand. And it's been the thesis that we actually have, I've invested in copper projects and copper mines over the last 20 years, has been on that basis. And it has proved to be a successful investment thesis. We just do not have enough supply, and it's getting worse. Grades are continuing to decline in the copper industry. The ability to bring in new projects is both capital intensive for the most part and difficult. The timing generally from discovery till a mine is built is increasing. It used to be about 7 to 8 years. We're now in the 10 to 15 year period from the time you discover something to be able to build it. And so all of these factors are playing heavily and really supports a very strong copper market going forward.
Yeah, as I've discussed on my own webinars, I mean, I get all these questions from our members about our electric vehicles gonna, eliminate demand for oil and everything. And I tell them one of the main things I see is all this build out of windmills and solar panels on electric vehicles. It's going to take a massive amount of materials.
Correct.
And I would list copper, nickel, at the top of that list of, rechargeable battery materials. They're just not out there. And it's going to, the cost of electric cars could go through the roof. And I think we're seeing a big surge in the cost of building materials and home prices in the Houston area, because lumber and all the material prices are going through the roof.
Well, let me give your listeners a bit of an interesting take on how copper fits in with this greening revolution. You're absolutely right. The greening copper is sitting quietly in the back. Yes, people talk about electric vehicles is going to go from 50 pounds of copper to 200 pounds of copper, but that's not where the real usage of copper is going to be. The real usage of copper is the infrastructure that's going to be required. So I have a great analogy for that. I bought my wife a Tesla about 4 or 5 years ago, and we put the required little plug in the garage in order to charge that car. And she loved it. I was thinking about, well, maybe I'll get a Tesla. So I talked to the electrician. He said, well, you can't actually have 2 Teslas in your house. Now, my house was built in 2001.
Yeah.
And I said, why? He said, because the copper pipe infrastructure coming into your house is such that you couldn't charge those 2 cars at the same time.
Wow.
And that, to me, is the little dirty secret that's sitting in the back.
I know. I totally agree. I've talked about this many times with some of our engineer members, and they say they just don't see how the power grid can handle the type of growth in cars that they're talking about, of electric cars, and I don't see it either. So I'm seeing more and more that there's no way demand for oil is going to go down, probably at least till well after 2030. And I'll be in a nursing home by then, so I won't care.
Yeah. So I mean, as we look forward, what we're going to see is you're going to see governments around the world looking at how they can put more power infrastructure in. They're going to be looking. I mean, I still believe it's a very interesting comment, because California has just announced that they're going to build 5 gas-fired power stations. I know.
They're actually firing up coal-fired power plants.
Correct.
Because they can't meet with their all their wind and solar and everything is not meeting their demand, so they're bringing back coal-fired power plants. It's amazing.
Look, I think governments are going to be very active in terms of putting this infrastructure in place, but I think you're absolutely right. It's going to take longer than people anticipate to wean off combustible cars. And there's combustion engine cars. I mean, I've got a couple of nice cars that I'm terrified that in 10 years, I won't be able to find a gas station to be able to.
No, you're not gonna have to worry about it. Hey, one of the things that affects us and our investments is hedging. A lot of these companies, when the oil price crashed, they went and locked in low prices just for survival to meet their debt payments. Do you have a hedging program, and is there a possible way to hedge, lock in some good copper prices?
So let's talk philosophically about this. Hedging, in people investing in our company, by default, do not want us to hedge because they want access to the optionality associated with the metal price.
Yeah, and I agree.
So as a management team, we are responsible to manage the company in a responsible manner. Hedging is an easy way out from management. So hedging can form part of a financing package,
right,
if necessary. We feel that that is an extreme and a very high cost of capital. And so we would look at that as something as a last resort if we ever were put into that position, because it would mean that we are financing something that all other costs of capital or other sources of capital have been taken away from us, that would be forced us into that high cost. And we actually look at that and go, whoa, are you playing with fire with the company at that point? Like you said, and forcing it into a position it shouldn't be in. I will say this, we do actively manage our foreign exchange exposure in Brazil, but that is generally on a 12 to 18-month basis. But we do not have any policy with respect to hedging the metal price. We feel that investors are seeking that exposure by owning our shares, and therefore it's not prudent for management to be seeking to do that.
Yeah. I worked for Hess for 18 years. In my last 3 years, I was part of a business development team. And the one thing where we correctly used hedging, I thought, was when we would do an acquisition, we would try to hedge in, put hedges in place to guarantee that that acquisition would pay out 3 years. And that was a good, because I will tell you, I think we lost more money on hedging than we ever gained. I mean, you were constantly paying out on hedges, not getting any money back on hedges. So I personally don't like them, but I can understand why companies do it, that are very, very dependent on commodity prices. And when you have these big swings in commodity prices, you got to hedge a little bit if you got debt. You've
got to be looking at your debt exposure with regards to.
Yeah, it's the debt. It's the debt that requires the hedging, not if you got a strong balance sheet like you guys got, and you can just, you can stay within cash flow. You just slow down your expiration program to agree with your cash flow. So
as Noel, my business partner, would say, and Noel used to run the Eurobond bond desk for Goldman, so is very knowledgeable of the markets. Noel says the best hedge that we can do is to be the lowest cost producer.
Right. Absolutely right. And yeah, as long as you got positive cash flow locked in with your low lifting costs, that's it. One more question. I say, I'll just ask, does Mako have anything he wants to jump on here and make a point that we missed?
Thanks, Dan. I appreciate the opportunity, but all the topics were very well covered. So we certainly appreciate the opportunity to join everyone this morning.
Okay, well then I'll go ahead and end it here. But man, I thought a great presentation. I'm excited about the company. I'm pretty tied up right now on updating a lot of stuff on the companies we follow. But sometime in September, I'm going to sit down and take a real hard look and set up a model for Arrow Copper. And it's a good chance it'll be getting into one of our model portfolios in our newsletter, probably in the September newsletter. And then, maybe later in the fall or something, especially when you finish your feasibility study on the BOA project, we can get back to Houston and get you in front of our live group here. I tell you, but before COVID, we used to have luncheons in Houston where we draw over 100 people. And, then COVID came along, and man, it just shut us down a year and a half ago. And our members are eager again to get that networking going again.
Well,
So Yeah. Well, thank you so much for hosting this for us. And we will definitely be following the company. And I'll just tell any of our listeners, if you have any more questions, please post them to the EPG forum and we will forward them to the company. Thanks a lot.